Hello, welcome to the next episode of Just Peachy. I'm your host, Peachie Thompson. Just Peachy is a show where we interview leaders and subject matter experts in the fields of insurance, finance, and taxes. And I'm so excited to talk about volatility today. And our next speaker is the owner and founder of Formula Wealth. He is also a CFP and a CPA, Mr. Chad Holmes. Chad, welcome, and thank you for joining us today.
Hey, Peachy, thank you for having me.
Chad, so why don't you tell us a little bit about yourself, how you got started in the business, and how you founded Formula Wealth?
Yeah, so I have always had the entrepreneurial spirit. I always wanted to have the ability to work for myself, and the opportunity arose years back when my wife and I moved to Texas for her to complete her general surgery residency. We were there for 5 years, and I joined a wealth management company there and learned a tremendous amount about the industry and how to do right by people, how to be a fiduciary, and always keep the client's interest ahead of your own. And at the end of my wife's residency program, we were scheduled to move up to Ohio for her fellowship training. And this is right around the time of COVID. So when we were about to have our first baby, and a lot happened, and we had to move across the country with a newborn. And because of COVID, we decided I would just stay home while she does her training. And during naps and nights and weekends, I would get this business off the ground, and finally got it up and running a couple years ago, October of 2020. And it's been a fun ride. Get to serve a lot of folks all over the country via Zoom meetings. And fortunately, it happened around the time when everybody was getting used to Zoom, no matter your age. And there's some silver lining in everything, I suppose. But it's been a really fun experience.
I love it. I love your story. And I'm sure a lot of people can relate. You know, starting your business in the middle of COVID, and the things that you and your wife are working together towards building something that is super awesome. So today we're going to talk about volatility, Chad. And you know, you hear this all the time. You're looking at the news. If you're an investor, you for sure have heard of it. So, but what is volatility really? When you say volatility, what does that mean?
Great question. So technically, the definition is it's a statistical measurement of a dispersion of returns, which is a lot of jib-jab. So what it really comes down to is how far away from the average are we getting every day? Is it a big swing away from the average? And when we refer to having volatile markets, we're saying, hey, we're having consistent days of big swings away from just, small gains or losses in the market. It's going to be 1 or 2 or 3% in the broad indexes that we're moving every single day. That's considered a volatile market. And it can be scary at times because it's not just in one direction. We're just not just skyrocketing. But there is that awesome zigzag pattern that makes it difficult to know what you're doing in the market or trading, and kind of scary with timing, trying to hey, I'm going to buy this. Oh, the price has already moved 2%. It's too late. So for active traders, it can be really scary.
Yeah, and really, I always ask my clients this, what keeps you up at night? And frankly, I've had people say volatility.
Yes, so when people are nervous about the market, sometimes it can come down to, honestly, just not being able to tune the noise out. There's so much information out there, so many people telling us to buy and sell and to panic, and it's kind of like, the house always wins. Wall Street always wins because by generating that fear or that FOMO, the fear of missing out, they trigger us to want to buy and sell and trade, and there's trade costs in doing so. So there's motivation behind others telling us what to do. For example, if someone's saying, hey, you need to buy Apple today, and that person already owns it, so they're going to benefit by you buying it. And also you have to ask, all right, well, at what price do I need to buy it? Because it's moved since the last time you looked at it, because it moves every second. So at what price is a good price to buy? And equally as important, what price is a good price to sell? Because nothing's going to outpace the market forever. And if you're not out earning the market, then there's no need to concentrate your risk into just one position. You need to just be a diversified investor and own the entire market.
And which is tough. That is really tough. So, all this scary stuff on the news, are we ever going to stop being volatile?
I think volatility is a necessary evil when it comes to investing. Without the risk of loss, we can't have great returns. That it's required for us to grow in prices, and with inflation and everything, there must be risk. Otherwise, there can't be much return. And one example I like to share with some clients is, and this is a really cool hypothetical, but let's pretend we're looking at 4 different stocks, and it's stocks A, B, C, and D. And they start at the same price, and years later they end at the same price. So it's the exact same overall experience, but the difference is how volatile each position is. So A is negative 50% of the time. B is negative 33% of the time. C, negative 25%. D, 20%. It's not a trick question. Which one would you rather have in your portfolio? And the answer is D. We'd rather have the one that's less volatile, that gets us to the same ending point. And that's a cool illustration, but what makes it really interesting is this isn't just a hypothetical. This represents the S&P 500 from 1970 to 2018, and the difference in the 4 stocks is A is the S&P's performance on a daily basis. So 50% of the days in that time period in the S&P 500 were negative. B is quarterly, C is monthly, B is monthly, C is quarterly, and D is annually. So 1 in 5 years is negative in the S&P 500 in that period. But when you look at it on a daily basis, it's about every other day on average. So volatility is always around. It's, like I said, it's required, but it's really interesting when you take a step back and look, not every day, but checking on your portfolio monthly, quarterly, or annually, you're going to have a much smoother investing experience because you're not seeing those daily, whiplash moves that we see in the market.
Oh, that makes perfect sense. And how many of us are so guilty of checking it out? There's apps now you can check. It's so easy to check how your investments are doing. So every single day you're staring at it. You're thinking, oh, now it's down. Oh, 40%, that's horrible, right? So then you're not sleeping, you're thinking about this. So how do you know? So, experts are always telling us, buy this, sell that. How do we know what to buy or what advice to follow?
Yeah, so the good investment is defined by, in my opinion, it's defined by your realized return, the amount you actually are able to walk away with in the end. And so what we know about the efficient market hypothesis is that prices always reflect all available public information, so outside of insider trading, everything we know about the world is reflected in these prices. Our hopes of recovery, our fears of rising rates, our fears of supply chains and COVID and war in Ukraine, and all that's baked into the price already because people are forced to drive these prices exactly where they need to be so that there's a positive expected rate of return. Eventually, the price gets too high, and what happens is the bubble pops. But in reality, it's at this high price, we can no longer see a positive expected rate of return. So we have to drive that price lower, and to do so, we sell. And that's what the bubble is when it pops, is we're selling to get out of it, and we're chasing the next big thing. But what's really happening is we're driving all prices to exactly where they need to be so that there's that positive expected rate of return. And we're not always right. We're constantly changing. There's obviously down days, but we're trying to find that price at all times. I used to teach, I used to go to a couple local campuses in Texas on college and go to business school and do a little, PowerPoint presentation, and me and my partner would bring a big jar of jelly beans that had 550 something jelly beans. She counted them all, and we would have the students, you've seen this example, come in and write down on a piece of paper, how many do you think are in there? And as we go about the presentation, we'd have somebody add up everything and deliver the average. And the guesses would range wildly. It was always nowhere close down below to way above, and everything in between. But without fail, every time we did this experiment, the average guess was darn near close to the exact number. And that was just an illustrative example of, hey, there's hundreds of billions of dollars chasing market prices every single day. Together as a society, as a public investors, we are driving those prices exactly where they need to be. And because we're doing that, it's almost impossible to predict which individual stock is going to outperform everything else. And on a risk-adjusted basis, by concentrating our risk, it needs to outperform by a lot, because I'm taking a lot of risk by just putting all my eggs in that basket, right? So for long-term investors, we believe that the best method of action is just get in the market and adjust your risk periodically, rebalance periodically, and over time, instead of trying to hit home runs every single day or every single year with your returns, just keep hitting singles. And it's a very boring and not exciting investing experience, but it's the way to do it when you want the long-term compounding effect of steady growth. Hitting those singles consistently over time really adds to your portfolio value. And not only just investment returns, but combining that with tax strategies. Do we put it in the tax deferred or the tax-free account? Do we withdraw from this account or that account during retirement? And doing all that truly adds a lot to your net worth, your portfolio, your investment experience over time. It's a really powerful experience when you step back and look at what you've done over a longer period of time.
Yeah.
And you can really, really see the good that it does, just staying committed to that plan.
I think you hit the nail on the head there, with consistency and staying the course, which reminds me, right? The market is down substantially year to date at the time of this recording. Is it time to panic? Get out for a while maybe until things calm down?
I certainly hate selling when the market is down. I hope nobody is forced to do so. If anything, I think when the market's down, it's a great time to buy for long-term investors. To me, the most powerful thing is knowing your risk tolerance, investing accordingly, and rebalancing. So let me explain what that means and what Formula Wealth and many other advisors will do out there. The first thing after getting a new client is we have to understand what their risk tolerance is. So what can you tolerate the market's volatility? So can you tolerate big swings? Are you going to lose sleep at night? I don't want your investment experience to be tied to your sleep schedule, because that's not healthy.
Yeah.
So, yeah, right. So what we do is through some people use questionnaires, some people just use discussions, some people just look at your age and have discussions, things like that. But so typically we look at it, and I'm oversimplifying this, but let's say a young person is investing for retirement. They've got decades to go. They can be more aggressive than someone approaching retirement, right? They've got a longer time horizon. And assuming they're educated, they can tolerate some volatility, if they're a disciplined investor. And so let's, for example, I call this an 80-20 portfolio, where the first number represents stocks / equities / the riskier side of the investments. The second number represents the percentage of fixed income / bonds or safer stuff. So younger person may be 80-20, an older person may be 50-50, right? So once we pinpoint that number, let's say a 30-year-old, you come in 80-20. Okay, great, we invest that way. And then guess what? The market's going to move. It's going to immediately, something's moved and you're not exactly where you're supposed to be. So we set up a band of tolerance, 3, 4, 5%, so that if it goes up to 85 or down to 75 on the stock side, then we know it's time to sell and get back to that mark. What this does over time is incredibly powerful. So let's say market does phenomenal. Instead of being 80-20, you look down at your portfolio, it's now 90-10, right? Because the stocks did so much better than the bonds. We say, I'm not a 90-10 kind of person, I'm an 80-20. So we have to sell the stocks when they're doing well and buy the bonds when they're a little more boring. No one wants to sell when they're doing high, but it is something that a disciplined investor should be doing. So we're taking our chips off the table, we're collecting our winnings, and we're putting them back into the portfolio in a different position. So now we're back at 80-20. The next year the market tanks, and you're down to 70-30. I'm not a 70-30 kind of person. I'm an 80-20. And so what we do is we sell those bonds on that 30% side, so because we got to get cash. So we sell those bonds that didn't crash near as much, and sometimes they appreciate during downturns. They act to serve as a contra asset, acting differently from the stocks. So we sell that 30% side some, and we buy the stocks that are down. So now we're back up to 80-20. What we're doing every single time is selling high and buying low, which anyone can recognize is a powerful approach to investing. Always sell high, always buy low. And it takes the emotion out of it. It takes the timing and decisions out. I know that it's scary, or I know that it's doing great right now. Doesn't matter. I need to get back to my score. Not because I know what's going to happen in the future, but because if I consistently do this over time, I'm going to be in a much more powerful position in the future, and I'm going to have a great investing experience over time.
That's a very, very succinct explanation of that. Tell me, when do I consider myself the 80-20, or when do I transition? There's the young girl, you can be more aggressive. When do I transition to the 50-50?
Yeah, so, obviously I can't give advice to individuals without meeting them or anything, but a general rule, I think in your 20s and 30s, maybe you're 90-10 or 80-20. 30s, 40s, assuming a normal mid-60s retirement anyway. 30s and 40s, you might be 80-20 to 70-30. 40s and 50s, probably getting into 70-30 and then to 60-40. And a lot of folks enjoy that 60-40 for the rest of their life. They don't ever go below that. If you're just a conservative person by nature, maybe you want to get to 50-50. But it's hard, and everybody's different, and maybe you have plenty of cash on hand and plenty of balance that you're not going to spend. But we can't ever get too conservative, because with every investment style, there's risk, right? And if we're too conservative, then we risk losing out to inflation. The bonds aren't going to keep up with inflation as much. They don't have as good a chance as the stocks do. So we need to typically always have exposure to the risk. It's just a matter of to what degree. And we don't want to get to retirement and then that day make that change down to 60-40, because guess what? What if that's the year that the stocks are down and then you have to sell? So you need to get to your long-term allocation a few years before retirement during a good period. And again, it is not fun to sell when everything is going well, but it's a disciplined and smart, prudent thing to do.
Some people might even say that that's too scary for me to do, because they want to hang on to it's up right now. Why would I do that, right? Some people think it doesn't make sense. But I understand. So is there such thing as taking advantage of volatility?
Yeah, I think there's absolutely a way to take advantage of the volatility, and that's that rebalancing that we were just speaking of. It's, hey, instead of once a year rebalancing, you can also do it during periods of crazy volatility. So this year would be a great example. When the stocks have been down, pick any day this year was probably a really good day to rebalance. And in doing so, you take advantage of that volatility because you're choosing to buy low when this, for this year anyway. Last year you'd have been selling high if you did a rebalance. And that is really the definition of taking advantage of volatility. So, it's really scary when markets are volatile. It's really hard to see the light at the end of the tunnel, because this is your money. This is what you've worked your whole life for. And to see it go down is terrifying. But if you have that long-term plan, you have a long-term investment horizon, I think sticking to that plan, rebalancing, staying in, taking advantage of volatility by selling high, buying low, those are your best moves in a long term. And it may take a while to see the fruits of that labor, but historically that has always come out and been the prudent move to make. With investing, if somebody needs money next year or even 2 years from now, say to put down a down payment on a house, I would not encourage them to put that in the stock market. Markets, they typically have 8 to 10 years is what's thought to be a market cycle. And so if you don't have a long horizon, it's hard to justify putting money in such a volatile world if you need it, next week, next year. I like to think of the market as really only for long-term kind of stuff. And the closer you get to the deadline, you take that risk off the table. It's like for 529 plans, those are tax advantage college savings plans. What is pretty common is to have the providers of these 529s, they'll have age-based plans, and with those age-based plans, the account is riskier when the child is born, and as they approach age 18, we take risk off the table, and less risk, so that by the time they're 18 and we need to withdraw the funds to pay for college, it's okay if the market crashes, because we're out of the market by then, or almost out of the market. And so that's what's so powerful about knowing your timeline and your risk appetite. You set that risk tolerance score, and you really don't have to think much about it after that. It really solves a lot of the, maybe not all the worry, but it does help calm the nerves sometimes when you remember, hey, I've got a long-term plan. I know what the ultimate goal is. And, working with an advisor, long-term plans, these retirement plans or financial plans, people call them, they expect recessions and downturns and crashes. Those are all factored in there. For the rest of my life, I expect there to be a lot more crashes, and that's okay, because I'm going to plan around that. I'm going to plan assuming those are going to happen, and when they happen, I'm going to be, it's okay, stick to the plan, rebalance, wait for us to come out on the other side, and then rebalance again, because I'll probably be too aggressive at that point once the markets rebound, so we sell when they get back too high.
Right. So, a lot of people don't think of it that way, right? So expect something to be bad. It's just not in our nature. I think you go into investing and thinking, oh, well, yeah, my money's going to earn something, right? And I am not thinking of there's going to be recession in my life, right? But it is very, very important for us to have that reality check. And I think that's really what it is. It's people have to go into this with the understanding that, hey, it's up and down, right? You can't expect to have always up, especially if you have such a short time horizon. And to your point, a lot of people probably don't even think of it that way. That's why it's very important to talk to a professional who can keep us in the right direction, or stay the course, in your own words, right? Stay the course. So, Chad, is there such thing as an uncorrelated asset?
Well, people tried to sell us Bitcoin and say that it was going to be uncorrelated, but we found that not to be true.
Yep.
It went down with the market just like everything else. There's always some, or typically there's some score of correlation. So although stocks and bonds are not 100% correlated, they're not going to go up at a 1-to-1 ratio. There are some years when they act differently, which would assume a negative correlation. So, when stocks go down, like in 2008, we had the bad market crash. Everyone was getting out of stocks. They were terrified of the stock market, and they would seek safety with their money. So where did they put it? They put it into U.S. government bonds. And so the bonds were going up while the stocks were going down. So some people, I've met with clients that are very anti-bonds because they're so boring. But we never know what asset class is going to be the winner. So it's good to own a little bit of everything, and you own it in an allocation that makes sense for you based on your risk tolerance. So I think it's good to own certain types of bonds. I don't like high yield bonds or junk bonds because those are seeking a lot of return. And in my opinion, if you're seeking return, you need to be in the equities. That's your safer bet for return. Yep. In my opinion, bonds serve a specific purpose, and that purpose is to act differently than the stocks. And this year, both stocks and bonds have gone down. Now, bonds haven't gone down near as much as the stocks, and so having those has helped the portfolio, but has not brought it up any. It's just slowed the detrimental fall. So I think, diversified, owning everything, and then tailoring it to exactly what your risk profile is really how we own different acting assets. And, you're not always going to only own the winners, but you're also never going to only own the losers. And so over time, like we mentioned earlier, it's about hitting singles and getting small wins every year. Introducing tax planning and insurance strategies with the investing experience to really add to your return over time.
Chad, you know what I'm going to do after this? I'm going to stop looking at my investments on the apps. I'm just going to leave it alone. Maybe look at it every 6 months, right?
If you're invested in a diversified portfolio that does automatic rebalancing, like a lot of 401ks allow you to do, I think that's a great strategy. It's so concerning and nerve-wracking to watch the news every day. There's interesting videos out there that just talk about tuning out the noise. We have to sometimes just turn off the TV. It's good to be informed, but it's an overwhelming amount of news with dozens of 24-hour news stations out there, and everything
stuff
has to be reported on as a crisis, or else it's not interesting and they don't get good ratings. So every event is blown out of proportion until the next event comes along, and then we forget about it. We don't care, and they're all affecting your portfolio, and you always have to buy or sell something, and it's just all this news all the time. And if you can just tune it out, step back, be diversified, and check in every 6 months or a year, make sure everything's still on track. Work with other professionals, advisors that can really make sure you're on the right track for you. Oh gosh, it's just such a nicer experience than just the constant fear that we're being driven into our hearts.
Oh yeah, those apps are getting deleted. You can count on it. Well, Chad, we can talk about this all day. I love it. It's very helpful. If there are any questions, how can people get a hold of you? I've
got the website is formulawealth.com. My email's chad@formulawealth.com. I think there's happy to talk with listeners and share some experiences with them, maybe point them in the right direction. But I appreciate you having me on. This is definitely an interesting topic and a very timely topic too. So I'm glad we went with this one because between this and inflation, that's pretty much all anybody's thinking about these days.
Oh yeah, that's what my question was. What keeps you up at night, right? It's inflation and volatility. A lot of people at least tell me that, So I truly enjoyed this, Chad. Thank you so much. Appreciate you being on the show, and I look forward to the next time we chat.
Sounds great. I look forward to seeing you in person in Denver in October.
Oh, right. Yeah, definitely. I look forward to seing you.
XYPN conference.
That's right. And then we'll be talking about all kinds of stuff. Well, insurance related, of course, but we're going to have a lot of good talks. I'm sure of it.
Yeah, I can't wait. Thank you so much for having me.
All right. Thanks, Chad. Bye-bye.
Bye.
Information shared during the show are opinions of the speakers. They are not legal, financial, or tax advice specific to you. Consult your own specialist, attorney, accountant, financial planner, or insurance advisor for your specific situation.
Bye.